Ever wondered how Amazon paid zero federal taxes on billions in profit? Yes, you heard it right. It's not a magic trick or some shady business practice. It's all about understanding the intricacies of tax law. Now, it's no secret that tax law, with its endless rules and regulations, can seem like a dense jungle to the uninitiated. But let's try to cut through the thicket. Imagine tax laws as an elaborate puzzle, filled with myriad loopholes and deductions that companies exploit to minimize their tax liability. It's not illegal, but rather it's a game of strategy, where knowledge is power. Large corporations like Amazon hire the best tax lawyers who know the ins and outs of this game and play it to their advantage. But don't be mistaken, this isn't just about big corporations. Understanding tax law can shed light on your own financial situation too. Understanding tax law can help you see the world in a whole new light. Tax law might seem complex, but it's just a set of rules about money. At its core, tax law is comprised of 4 key principles: income, deductions, credits, and tax rates. Let's break these down one at a time. First off, income. In the world of tax, income isn't just about the paycheck you get from your job. It can also come from investments, rental properties, or even a side gig selling handmade crafts online. Essentially, if you're making money, it's considered income, and it's subject to tax. Next, we have deductions. Think of deductions as the expenses that you can subtract from your income before your tax is calculated. These can range from the cost of your health insurance to the interest on your student loans. Deductions lower your taxable income, meaning you'll owe less tax at the end of the day. Now let's chat about credits. Tax credits are a bit like coupons for your tax bill. They directly reduce the amount of tax you owe, dollar for dollar. For example, if you owe $2,000 in taxes and you have a $500 tax credit, you'll only pay $1,500. Last but certainly not least, we have tax rates. The government determines what percentage of your income you'll pay in taxes based on a tiered system. The more you earn, the higher your tax rate. But remember, this is a progressive system, meaning only the income over a certain threshold is taxed at the higher rate, not your entire income. So when you put it all together, tax law is a balancing act between income and deductions, credits, and tax rates. It's a system designed to ensure everyone pays their fair share based on their ability to pay. So, in essence, tax law is about how much of your income you keep and how much you give to the government. You've probably heard of a progressive tax system, but what does that really mean? Well, let's break it down. A progressive tax system, in its most basic form, is a tax system where those who earn more pay more, not just in terms of the total amount, but as a percentage of their income. Imagine a simple scenario. Let's say we have 3 individuals, Alice, Bob, and Charlie. Alice earns $30,000 a year, Bob earns $60,000, and Charlie's doing quite well for himself and rakes in a cool $100,000 annually. In a flat tax system, they would all pay the same percentage of their income, let's say 20%. This means Alice would pay $6,000, Bob would pay $12,000, and Charlie $20,000. Seems fair on the surface, right? However, that $6,000 might mean the difference between Alice being able to afford her rent or not, while Charlie might not even notice the $20,000 missing from his bank account. Now, let's imagine the same scenario in a progressive tax system. Here, the tax rate increases as the taxable amount increases. So, Alice might pay 10% of her income, Bob 15%, and Charlie 25%. This means Alice would pay $3,000, Bob would pay $9,000, and Charlie a whopping $25,000. At first glance, it might seem like Charlie is getting a raw deal. But remember, Charlie is still taking home $75,000 after taxes, while Alice is left with $27,000. In a progressive tax system, the burden of tax is shared more equitably among the population, with those who have more contributing more. This system is not without its critics, of course. Some argue it disincentivizes earning more, while others believe it's the fairest way to distribute the tax burden. But one thing is clear. In a progressive tax system, tax law serves as more than just a means of generating revenue. It becomes a tool for wealth distribution. In a progressive system, tax law is a tool for wealth distribution. Now let's delve into the world of corporate tax law. In this labyrinth of legalese, we find ourselves navigating the nuances of how corporations are taxed on their profits. It's a fascinating journey, full of strategies and tactics used by businesses big and small to ensure they're paying their fair share, but not a penny more. Let's start by understanding the basics. Corporations are taxed on their profits, which are their revenues minus costs. However, the actual calculation can be much more complex. The tax rate applied to these profits varies from country to country, and sometimes even within different states of the same country. In the United States, for example, the corporate tax rate currently stands at 21%. Now, while that might seem like a significant chunk of a corporation's profits, there's more to the story. Corporations can actually reduce their taxable income through deductions and credits. Deductions can include a wide range of business expenses, from employee salaries to office supplies. Credits, on the other hand, are a direct reduction of the tax owed and can be earned for various activities like research and development or energy efficiency improvements. Let's take the example of our friend from Scene 1, Amazon. In recent years, Amazon has been in the headlines for paying zero in federal income taxes, despite making billions in profits. How is this possible? Well, it's all about strategy. Amazon, like many corporations, makes full use of the available deductions and credits. They invest heavily in research and development, which earns them significant tax credits. They also take advantage of depreciation deductions on their vast physical assets, like warehouses and data centers. As you can see, corporate tax law isn't just about paying taxes. It's about understanding the system and using it to a corporation's advantage. It's about strategy, about planning, and about making smart decisions that can save a corporation millions or even billions in taxes. As you can see, corporate tax law is a game of strategy. But tax law isn't just about one country, there's a whole world out there. Welcome to the fascinating realm of international tax law, where every nation's tax policy interacts with the others in a complex global ballet. This is where the rules of one country meet those of another, and the dance begins. Let's start with the basic concept. International tax law refers to how countries tax foreign income. Imagine a British company doing business in Japan. Japan may want to tax the profits earned there, but so might the UK. To prevent the same income from being taxed twice, we have something called double tax treaties. These are agreements between two countries that lay out the rules for how they will tax each other's residents and businesses. So what exactly are these rules? Well, they can range from which country has the right to tax certain types of income to how tax disputes between the two countries are resolved. It's a bit like a prenuptial agreement, but for countries. Each country has its own set of tax treaties with other countries, which can make international tax law incredibly complex. But the goal is always the same: to prevent double taxation and to avoid tax evasion. Now, you might be wondering, how does a country go about taxing foreign income? Well, there are two basic methods: the credit method and the exemption method. The credit method allows taxpayers to claim a credit for foreign taxes paid, while the exemption method simply excludes foreign income from taxable income. It's important to note that while these methods are widely used, they're not the only ones. Some countries use a mixture of both, while others have their own unique approaches. And that, in a nutshell, is international tax law. It's a delicate balancing act, where countries must negotiate and cooperate to ensure a fair and efficient global tax system. It's not always smooth sailing, and disputes do arise, but that's where the dance of diplomacy comes in. So, international tax law is like a global dance, with each country trying to get their fair share. So why should you care about tax law? Quite simply, tax law impacts every corner of our lives, from the individual to the corporate level, and even the broader society. It's the financial fuel that powers the public services we often take for granted. Every time you visit a public park, drive on a well-maintained road, or borrow a book from the library, you're experiencing the impact of tax law. On a larger scale, tax law shapes economic policy, influencing business growth, job creation, and market stability. For corporations, understanding tax law can mean the difference between profit and loss. It determines how much they contribute to the societal pot and how they strategize their business operations. So it's not just about filling out forms and paying what's due once a year. It's about comprehending the financial network that binds us all together. Understanding tax law is more than just about paying your taxes. It's about understanding how our society works.